Global news tonight, the long-struggling Eurozone recovers with its reading for March rising to 100 from 99.9 in February. And Germany contributed to this recovery. They led the Eurozone, industrial production reading edging up to 99.8 from 99.7. So joining us now for more on the global market is Richard North, Joint Country Director at Saxo Capital Markets. Good evening, Richard. There we talked about that European stuff coming out, other things to catch the eye for you, US retail sales and Japanese bonds. So let's talk first about that European production.
Yeah, it's a little bit confusing on this turnaround Tuesday. We've seen just over a 1% swing in the markets. So I brought along a little help tonight, a little crystal ball, just to try and
we need that.
make sense of this market.
We definitely need that.
And to be honest, it's a little bit fuzzy in there.
Yes.
We saw France come out last week. Industrial production was down 2.5%. If it wasn't for Germany, a little bit of and Spain coming into these numbers, there wouldn't be anything really to talk about. So it's to justify a 1% swing around from being down 0.5% to being up over 0.5% is, in my mind, a little bit generous today. Interesting to see, on the Japanese front, they try to produce massive inflation in the country. All they've done is increase the government 5-year debt by over 200%. So given the fact that if that wasn't a politician, it was a CEO of a company, you can imagine that his job would be on the line. So it's really a tricky situation. Can we justify the fact that the market is up, anywhere between 13 and 15% over the last few months?
Also, sometimes one gets the impression that all the data that we got a surfeit of information, and even if it's slight movements, we want something to talk about and people react to it. It's almost like in the days before there was instant information, you had perhaps better information.
Well, it's a very tough thing to say. If you look at the divergence between the macro situation and the markets at the moment, it's clear that you need the crystal ball. We've seen 40% decrease in the macro environment in developed markets over the last 6 months, and we've seen massive increase in the actual underlying stock markets. Who does that benefit? And really,
perhaps more importantly, when does it end? When does that?
Well, it ends with the free money stocks. I mean, it's quite easy why the stock markets have gone up is that there's a massive amount of money sloshing around in the system that you can borrow at virtually nothing, or you can invest it in a bank as a deposit or buy a government bond at virtually nothing. So it's going to chase the 3%, 4%, 2% dividend yields on the share market, and it's going to push the share market up. So, I mean, at the end of the day, liquidity or the lack thereof drive markets up and down. That's actually what drives it. Now, normally, liquidity will be determined by what's happening in the economy. So normally the stock market would be coupled to the economy. But at the moment, there's this artificial situation where there's massive liquidity, excess liquidity in the system. That's driving the market. When it comes to an end is when the liquidity dries up. But the question is, when does that happen? It doesn't look like it in the short term.
Just look sideways at Richard's crystal ball and tell us when you get a different angle there. See, when is it going to end? When do the musical chairs stop playing?
Well, I mean, he just said that the macro is going bad, and yet the stock market is going up. So I guess liquidity will continue for as long as the macro is going bad. And, but as an investor, you don't want to play for that because when it's time to leave, when liquidity gets pulled back and you want to get out the door, that's a very small door and many people trying to get out at the same time. So it's very important to maintain a vigilant posture.
Richard, based on what you've just said, let's look at the crystal ball.
It's fantastic to hear someone speaking some sense on this. You've got to take some sort of hedge against the situation. That door is not big enough for everyone to come on the exit. Right now, right this second, they are arguing in Brussels as to who's going to take the losses in the banking industry in Europe. You're sitting there. When those chips need to get taken off the table, there's going to be a bit of a panic. We're skiing in front of the avalanche. I'm just saying, be prudent. I 100% agree with Wayne. There's money coming in. The market has to do something with it. We saw Apple, biggest ever corporate bond issue in history, 17 billion. What happened 2 days ago? Biggest emerging market bond issue in history with Petrobras coming through from Brazil. This is, who knows what Apple's going to, they're already sitting on, money that's bigger than the GDP of Greece and those countries. What are they going to do with this money? It's incredible.
Look, I suppose if you're a company and you can raise money at 1%, 2%, 3% for 20, 10, 20 years, whatever, you must do it because you're not going to get an opportunity like this again, But But it'll all come to an end, and it's interesting. Richard was talking earlier on about Japanese bonds. I mean, I've been waiting for the Japanese bond rate to rise since 1993. You know, and it's taken a long time, but it hasn't really happened yet.
Sheila, you were going to say something?
I was going to say bond issuances, share IPOs in the United States, or capital raisings, secondary capital raising, all that's happening for one reason only. When you think about it, you ask, why are you doing this? Because I can.
Yeah.
Isn't that an answer? Because I can.
Not because I need it.
Very smart people tell you, because I can.
Richard, you said earlier about it's that bad news is good news thing. You know, the fundamental economic stuff, we need to keep supporting it so the markets say, great, that money's continuing to flow. What does the crystal ball say about eventually this has got a crack?
It says that most politicians must have their money in the stock market right now or over the last few years. I mean, this is unbelievable amount of support that they've had for this market. Wayne showing his age a little bit there, going back that far. And
1999, that's 93,
93, yeah.
That's not so long ago.
Depends on what viewpoint you're looking at it from.
But it certainly is scary, and you know, from that point of view. But the reality is, if we look at everyone's been talking about deflation, and we've seen oil price and things like that. In emerging markets, though, we're seeing a bit of a pressure on inflation. I mean, we just need to go back to your story on wage increases in the mines and what effect that has. If you're sitting in the current rates where they are now, if the rates come down, what's that going to do? You're going to be potentially looking at negative yields on your money. And so the simple reality, as long as that macro situation's around, but you have to add on the caveat that as long as the governments are supporting the inflow of money and QE continues. But I think it'd be very interesting if you look at the Japanese situation, you equate that to the US. I hate to think what they're going to do when their bill goes up by a couple of basis points.
Yeah. Now look, I mean, what will happen is what happened in other occasions for different reasons. Other occasions, liquidity was released because interest rates fell and it worked. Now it hasn't really worked. The government's had to pump the money in. But what will happen is the liquidity will dry up as the economy improves. And then the argument will be the market will be, look, I know the liquidity is drying up, but the economy is getting better. So the stock market will probably rise or sustain its level for a while until people realize, hang on a second, the liquidity actually was by far the more dominant. So you'll still hear good news. When liquidity is withdrawn, it'll be withdrawn and in a good news environment. So be careful then, because then it's easy to get fooled. But I mean, that scenario is a long time out.
Richard, South Africa in the context of our economy, of what you've been saying.
Yeah, I'm going to paint a bullish picture. And let's take the platinum sector, for example. It's fantastic to hear talking about the situation is that, if you're not standing on the edge and making those decisions. So from a stock market timing point of view, you should be invested when they're standing right on the edge in that last thing, and so I'm going to be a little cynical here. I view what's happening in the platinum sector as a fantastic opportunity for the youth in South Africa. You're going to potentially get platinum stocks at the cheapest that they've been in since Wayne joined the market. So I'm painting a little bit of a bullish picture on that. Don't be scared. The greatest thing that can happen for young investors wanting to get into the market and mature investors is when the market comes off, it's going to present opportunities.
Well, apparently the ETFs are going very well, so people are clearly looking at that kind of investment in platinum. 8 tons, I gather, was bought since that ETF was launched 10 days ago.
Yeah, new listing coming in, but that goes exactly back to the discussion we're talking about. People are buying the commodity as opposed to the stock. Why would you, take it, gold, silver, platinum, copper, any of those commodities at the moment? Why would you be buying the shares in South Africa when you could be buying the actual underlying commodity?